the role of intangibles in M&Es, different types, and exactly what does that mean in the guidance. So how does the transfer pricing guidance define intangibles, and we'll see how that differs from other legal and accounting notions. Then we'll move on to talk about how does the transfer pricing guidance, especially the OECD guidelines, apply to intangibles, and we'll talk a bit about the challenges and the difficult issues in that application, and also the relevant points that you may really care about as an M&E, and if you provide services to M&Es, what are the points that you should be aware of in order to understand transfer pricing in relation to intangibles. Then we'll talk about particular issues with valuing intangibles and evaluating the fair market value or the arm's length price for intangibles. And very shortly, we'll talk about the transfer pricing guidance on cost contribution arrangements. So we'll start with the introduction on intangibles. Intangibles, as most of us are very aware, may add very significant value to a business. They are often the most valuable assets of many of the most valuable businesses on the planet. So if we think about some of the technology giants and some of the staple blue chip companies, we will immediately recognize a huge value in their intangibles, be it their marketing intangibles or their process intangibles. And by process intangibles, I mean things like formulas. For example, now the COVID vaccine has been developed. There will be a formula for that. Processes, how have those intangibles been developed? Or, for example, in the context of a manufacturing process, how is that operated? Those are examples of process intangibles. Marketing intangibles could include anything that is related to the image, to the public image of the company. So that would be the brand name, the logos, the logos and brands of the products. So we're talking about many different kinds of intangibles. For example, if you think of the Coca-Cola brand, the brand itself has is estimated to value more than 50% of the company's total value. So we are talking about really some of the biggest key drivers in businesses. So when we talk about intangibles, we're talking about massive amounts of money, and of course there are huge provisions made by multinationals about tax and transfer pricing risks. And of course, intangibles are one of the key issues, because tax authorities will of course have priorities in how they allocate efforts, and looking at intangibles, valuable intangibles, is certainly an easy way for tax authorities to challenge transactions and raise tax revenue. So when we talk about intangibles, we definitely talk about one of the key issues for transfer pricing and taxation in an international context. Well, intangibles are easily transferable. They are sometimes difficult to identify, as we'll see further. And of course, they can be easily transferred or reallocated in the context of classic tax planning. Let's put it that way. And therefore, of course, they attract a lot of attention from governments and also from the media. So some of the structures that came public in later years of certain multinationals using intangible or in relation to intangibles have become quite famous. So, you know, intangibles for transfer pricing purposes, and we'll look at the definition in a moment. They can be things that are that exceed vastly the intangibles definition in for accounting purposes or for other legal purposes. Accounting-wise, typically patents are accounted for, but many other kinds of intangibles simply do not show in the balance sheet of companies. Unless they are acquired, in which case they may be part of the goodwill. So still in those cases, they may not be clearly discriminated. What is it that this intangible is? So intangibles may include things like know-how, the fact that you have contracts with employees that are experienced and that have special knowledge. And we will see that there's very interesting and difficult problems when those employees spend some time in other companies of the group or are seconded to other companies of the group, and questions may arise as to whether a transfer of intangible has occurred. So those are really problematic sort of issues. So you amongst intangibles, you have know-how, you may have trade secrets, client lists, you may have indeed trade names, trademarks, brands, other types of government licenses, and many other types of intangibles. Now, for example, I want to make a clear distinction there, because when I mean that know-how is an intangible in itself, but of course, multinationals do not own people, so an employee is not an asset. It's not even an intangible asset. What is an asset, and could be an intangible asset, is the right to a workforce in place. So if you have contractual rights to have a certain group of people working for you, and you have invested into hiring and to building a certain team, that can be an intangible. Now, the OECD is very clear that synergies are not an intangible, and we'll see why. Because synergies which result from concerted group action cannot be owned by a single entity, and therefore they cannot be an intangible. And also market-specific characteristics, for example, the good weather or even the access to a certain market should, from the OECD's perspective, not be seen as an intangible. And that has been debated from the perspective of some of the largest developing countries, such as India, that has challenged that position, but not very successfully. So the definition of intangibles in the OECD transfer pricing guidelines is something of value which can be owned or controlled, and which is not a physical asset or a financial asset. And of course, the intangible, it's interesting to see that intangibles, they do not need necessarily to be transferred separately. They may be embedded on other assets, other services, other sorts of transactions. They may be transferred between group parties. And so it's extremely difficult to identify some of these intangibles in the context of a complex value chain. So the life cycle of intangibles is also highly dependent on the type of intangible, and these are very different life cycles than normal tangible assets or other financial assets, because typically a normal tangible asset is bought, then or produced. They are used, sometimes depreciated or amortized, and they may be at the end sold or fully depreciated. Well, intangibles are a bit more fluid. They can, of course, be bought or developed in-house, and of course, when they are developed in-house, that creates particular problems in identifying when has the intangible been fully developed, and also to identify the contributions that have been made over time of various kinds to that development. And we'll see how that poses a number of issues. So moving on to the challenges in applying the arm's length principle to intangibles and on the guidance. The OECD transfer pricing guidelines on Chapter 4 contain 4 sections regarding intangibles. They talk about identifying intangibles, and then they talk about a concept that will be extremely important and we'll discuss further, which is the DEMPI functions. So in order to understand the difference between mere legal ownership and I know this is familiar to many of you because, of course, in Cyprus, the concept of economic ownership is also provided in the IP law, in the IP regime that we'll not discuss here. But essentially, the idea of the OECD is to provide for a substance principle here, where even though a certain party may own legally an intangible, that does not necessarily mean that that party is entitled to the revenues from the intangible. And so most of the revenues will be attributable to the entities that perform the DEMPI functions. And what are the DEMPI functions? It's really just a generic expression that refers to the key, most important functions performed. And this is about decision-making capabilities and actually exercising that control over the decisions in relation to the intangibles. And the DEMPI refers, it's a sigla that refers to the examples given by the OECD. So that could be functions of development, enhancement, maintenance, protection, and exploitation of intangibles. But these are not exhaustive. There could be others that are also considered to be key functions in relation to intangibles. But they are referred to as DEMPI functions, and that's how we will refer to them in this presentation. Then the guidance talks about transactions, the nature of the transactions involving the transfer of intangibles, and provide supplemental guidance to determine the arm's length prices. Essentially, in sum, to analyze transactions involving intangibles, it is first necessary to identify the intangibles with specificity, to identify the contractual arrangements, so the terms of the contracts in place and the responsibilities and the allocation of different risks and assets between the related parties, to perform a functional analysis of the parties in relation to the intangibles, in order to understand who performs the DEMPI functions or a portion of the DEMPI functions in relation to a particular intangible. And then to verify whether the contractual allocation of risks and expectations and functions matches the actual performance of the DEMPI functions. So if the two are consistent, then we move on to pricing the transaction. But if they are not consistent, we should delineate the transaction. We should reinterpret the transaction in light of the DEMPI function. So the DEMPI functions will override the contractual arrangements. That's the goal of the OECD, and this operates really as an anti-abuse or anti-avoidance mechanism. If there is a mismatch between contractual arrangements and the DEMPI functions will override the contracts for transfer pricing purposes. And then, of course, the arm's length price for the transactions with the intangibles should be consistent with the transaction as accurately delineated and should remunerate the parties for their contributions in generating value. And here there's a reference in the guidance to determining risk-free and risk-adjusted returns in relation to the IP. So if an entity legally owns a valuable intangible but doesn't perform any of the DEMPI functions, it would be expected that that entity will be allocated the risk-free return, but will not be entitled to the risk-adjusted return. That means to the bulk, to the major part of the return. So the risk-free return is typically determined by reference to a government bond. So let's say that if we're talking about dollars, that will be the U.S. government or Treasury bond yield could be a proxy for a risk-free rate. So whatever is above that will be the risk-adjusted return, and that goes to the Dempsey functions, whoever performs them. The guidelines further provide for comparability factors specific for intangibles. So as you probably are aware, there are 5 comparability factors that are generally applicable in transfer pricing. These elements are specific to intangibles to look at whether an intangible is provided with exclusivity or not in a certain market, the duration of the license, for example, or the patent, or the right to use that intangible, the geographic scope, so the areas where it is where it applies and where it's protected, the useful life. This is always a key point, especially in valuations. What is the useful life of a particular intangible is always a key aspect, and often very difficult to determine accurately. And that's also why, as practitioners, it's very important to apply several sensitivity analyses and make sure that the approach is very robust. We will get to that in a moment. And of course, the stage of development. So there may be different stages of development for intangibles, and the specific rights and the expectation of future benefit at that point. These are all relevant comparability factors listed in the guidelines. So in relation to intangibles, the 6-step approach provided by the OECD in paragraph 1.60 is also applicable to intangibles or to risks in relation to intangible transactions. And it very much works in the same way as what I have just explained for checking whether there is an alignment between contracts and Dempsey functions. Here, we check whether there is, in relation to risks, whether there is an alignment between the contractual allocation of risks and the control over risk functions, which are the functions of the key decision makers in the company that have the capability and the responsibility to decide to take on risks or to forego risky opportunities, and to also decide to hedge risks or to delegate day-to-day risk management, which has specific conditions. So in order to delegate risk management but retain control of risk, the party should set objectives and check whether the performance has met those objectives, and consider engaging another party for the day-to-day management of the risks. So examples of key risks in relation to intangibles could be, for example, relating to the future development, the product obsolescence, infringement of rights, and product liability. Now, of course, as we all realized already, applying the arm's length principle to intangibles has many challenges. One of them, of course, is the scarcity of comparable transactions. So it's difficult to find patents, to find license agreements that have the same terms that apply to the same intangibles. We could just think of a couple of cases. I mean, the Apple brand. What do we compare the Apple brand with? I'm sure there are other providers of cell phones, but do they have the same value as the Apple brand? It's very difficult to find proper comparables to a unique brand, and that's of course creates issues. There are of course cases where comparables can be used because the brands are not so unique that you cannot find another similar brand in the market, but in many cases they are very unique and there are no comparables. So that's certainly a challenge in applying the arm's length principle. Intangibles may be used by many group members. It's difficult to isolate and even identify intangible related income, because sometimes there's an intangible transaction that is connected with other service, with the provision of services, with the provision of goods. For example, if we sell pharmaceutical products, a drug, typically there will be several intangibles there. There will be, so that we are talking about the sale of goods, the sale of, for example, the COVID vaccine. But in that drug, there will be a number of intangibles. There will be the formula, there will be the process to produce it, there will be the name of the product, and there will be the brand name of the pharmaceutical company. So just from a high level, we're talking about various brands that may be managed by different group parties. And so we may have also various group members performing DEMPI functions. There are also interesting and very complex problems around timing. So you may have a period where a lot of investment is put into developing intangibles, and these intangibles will only generate significant returns in later years. What if the intangible is transferred at this stage? That can create a lot of uncertainty about how much returns will actually be generated. Then there are other sorts of issues, such as determining contractual arrangements, the funding, the risk structure, and so on, just to cite a few. With respect to intangibles that are developed in-house, there are basically two routes to develop intangibles. One is contract R&D. So it's the company develops the research and development process within the company, which can also be, of course, outsourced to a third party, but that will be outside of the scope of transfer pricing. Or the company can enter into a cost contribution arrangement, which we'll briefly discuss later on. The benefit of the R&D typically stays with the principal in a contract R&D structure. And there's, of course, significant tax planning around this issue. But we will see that the principle, in order for that system to be consistent with the guidance and to work, needs to retain control over the development. So it needs to have control over the risks of the development and perform the DEMPI function. So we will see that in a moment. So I think this is probably one of the most important slides, because it allows us to talk about a number of issues. So here we have a multinational enterprise, and let's assume that these are related parties. So we have a principal which acts as an entrepreneur. So the principal is expected to take a lot of risk. By the way, if an entity takes a lot of risk, that means that the entity has a lot of profit potential, but it also has the potential to make significant losses. So whenever you hear tax authorities or whoever else saying that if there's a lot of risk in an entity, that means that the entity should have a lot of profit, that is completely wrong. The fact that an entity has a lot of risk means that the entity has a lot of profit potential, but also may have a lot of losses, so anywhere in between. So that's a very important point. And the principal is an entrepreneur, or at least that's the design that a group may have. But then the problem is that is only going to be respected for transfer pricing in relation to intangibles if the principal actually performs the DEMPI functions. And so in this structure, we have a principal that outsources or enters into a contract R&D, contract for research and development of intangibles with a group party, and pays a service fee. So what this means is that the intangibles produced by the contract R&D entity will be owned by the principal, and the contract R&D entity is only going to get a service fee, but is not going to be entitled to the returns from the intangibles. So in order for this arrangement to be respected for transfer pricing purposes, the principal needs to control the risks of the transaction. This means that the principal needs to really, as we just mentioned, in order to delegate the day-to-day activities in relation to R&D, the principal needs to set a budget, to set objectives, to regularly verify whether the contract R&D party is meeting those objectives, and to consider whether to change provider if the objectives are not met, and to monitor the process on a high-level basis, not on a day-to-day basis, but on key points of the decision on whether to invest or not to invest. And also the principal needs to be the one that has access to financial capacity to engage the contract R&D. So this is the arrangement with regards to the R&D. But then once the principal has the IP, it can license it directly to customers, or it can license it to related party entities, the licensees that we see on the structure, through an IP company. And this is a very common structure to use an IP company for several reasons: to manage the IP, to benefit from regulatory and business advantages, and also, of course, because the IP company may be located in a jurisdiction that at least does not represent a higher tax. So the IP company will typically be located in a jurisdiction that has access to a lot of tax treaties. And here, one of the relevant comments is that royalties paid in relation to IP, at least if we think about the OECD Model Tax Convention, they are only entitled to the reduced withholding tax provided in the tax treaty if they are at arm's length. So the royalties needs to be at arm's length. Any exceeding royalty, in addition, that is not at arm's length will not benefit from the protection of the treaty. But in transfer pricing terms, there's a number of things that we can think here, because the first thing that we need to consider when applying the guidance is looking at what are the functions performed by the parties here. Are some of the DMPI functions performed by the IP company? And if so, maybe the IP company is going to be entitled to a lot of the license fee under the sub-license to the ultimate licensees. So those are very relevant aspects. If the IP company and the IP company may have different functional profiles, it may be an agent with very limited functions and risks, where it will be expected to earn very much something like a service fee, or it may be a risk-taking function, a risk-taking entity that adds value to the business and that performs a number of functions such as IP protection, maybe maintenance, maybe it invests on various aspects in relation to the IP. And in that case, the IP entity, the IP company may not be entitled to the income from the IPs in the sense that it doesn't perform most of the IP functions, but it does add value and it should have a higher service fee. And it could be indeed a strategic company that takes a significant part of the risk, also performs some of the DMPI functions. And so in that case, the IP company alongside with the principal will be entitled to the revenues from the license. So these are different archetypes of functional profiles where the IP company may fall, and this will determine the level of risk and the level of remuneration of the IP company, which will also reflect it's directly linked with its economic activities, with the performance of the DMPI functions. Other things that we may think about looking at this structure is, for example, are there transfers of intangibles throughout the life throughout the operations of the group? For example, if there's secondment of individuals, could this lead to a transfer of IP? Who uses intangibles? Maybe more than maybe several parties use intangibles in their day-to-day activities, which could affect the structure. So there's a number of aspects to consider. Moving on to the third topic, valuation of intangibles, and we'll see why we jump into valuation of intangibles. It's because when we talk about transfer pricing methods, the OECD guidelines provide that the CAP may be an appropriate method. Transactional profit split may be as well appropriate, and valuation techniques are recognized as useful tools. The transactional profit split is appropriate for cases where we have valuable and unique intangibles being used by multiple parties, also for highly integrated transactions, but not for every transaction. The CAP method relies in close comparability, and so it may be hard to apply for a number of very unique types of intangibles. And so, apologies for it. So we are left with valuation techniques for a certain number of intangibles. The valuation techniques, of course, involve, like anything in transfer pricing, involve a certain degree of subjectivity. So they need to be supported by reference to economic value, which depends on many factors. They will require a number of assumptions regarding the future earnings related to the IP, growth rates, the cost of capital, discount rates. Naturally, the value of the intangible may also fluctuate. So the moment at which an intangible is transferred is key, and there may be a number of aspects such as market factors, competitors, new products that affect the value. And of course, the valuation is stronger with a two-sided analysis where which considers the perspective of the seller as well as the perspective of the buyer. So if there are specific synergies to the buyer, if there are advantages that are specific to the buyer side, that should not be overlooked as well, and that's sometimes the case. Valuations naturally involve a number of challenges. One of them is that if they rely on empirical data, they struggle. We struggle again with finding comparables, patents, license agreements. A lot of that databases on the market offer license agreements that are based on US SEC filings, but those are sometimes limited, and so of course it's better to have access to a broader base, but even so, it's very difficult to find comparables to very unique brands, as we just established before. And of course, IP rights are often transferred in combination with other services or goods. Those are often called embedded services, which add to the complexity of determining how much of that value is paid for the intangible and how much is paid for the service or the transfer of goods. Highly complex matters. And lastly, intangibles are even difficult to identify. So a lot of companies struggle in determining when has the intangible been created, when does it originate, and to map the intangible, to understand which parties have which intangibles, which functions are performed in relation to the intangibles. And here, of course, technology and software may play a very useful role in supporting mapping and being used also by multinationals in relation to negotiations with the authorities and also filing for APAs or tax rulings. The fundamental question when thinking about valuing intangibles whose value is highly uncertain at the time of the transaction is what would independent parties do in this situation? How would they have split the benefits of the transaction? So one of the things that is necessary is to estimate the anticipated benefits from the intangible. And that means that we look at the situation at the time the intangibles are transferred. And we will look at, as per the guidance of the OECD, the options realistically available to both parties. So we will look at the alternatives to the buyer or seller and to determine the conditions of the transaction. Uncertainty may be dealt with short-term agreements, with the possibility to renegotiate the price at a later stage, or price adjustment mechanisms. It's very common to have a mechanism that says, well, this intangible is sold in 2020, but if in the next 3 years the value of the intangible increases by more than 25%, then the price will suffer an adjustment of a certain amount. So that's also very common in third-party agreements, and these are types of clauses that would be expected to be included also in related party agreements where they make sense. In order to value intangibles, typically there are 3 approaches that are commonly used. I'm not going to go into detail in the interest of time, but essentially there's income-based approaches, market-based approaches, which are basically relying on empirical information, and cost-based approaches. And the OECD guidelines provide some level of detail, but of course, some high level of detail, I would say. All the methodologies have strengths and weaknesses, and they are highly dependent on the type and nature of the intangible. So it's recommendable to use more than one method to have a strong outcome and a strong view on the value, unless there is one method that is clearly the most appropriate. Or for cases where there is one method that can be applied and the other methods are very hard or very, or either they don't apply or their results are not so reliable. The guidance, so the OECD has provided additional guidance on how to value intangibles in June 2018. The guidance refers to the mutual agreement procedure in tax treaties, so makes that reference in order to settle some of the problems that may arise as a result of hard to value intangibles. Some of the takeaways of the guidance is that taxpayers should look to identify hard to value intangibles as soon as possible, and the TP approach for hard to value intangibles should be solid and consistent. And taxpayers may also consider to seek APAs and tax rulings in various jurisdictions in order to secure that advanced certainty in regards to the tax treatment of those intangibles, and to avoid situations of double taxation, which are of course which arise easily in this context. So what are hard to value intangibles for the OECD? They are intangibles where there are no comparables, no reliable comparables, and where the projections of future cash flows are highly uncertain. So it's sort of, for a classical example would be what is called as blue sky research and development. That would be that would maybe generate intangibles that could potentially be useful, but we have at that point, at the point of development, no idea of how much value will be derived from the intangibles. Or for example, certain products that are that could have applications on Earth, but which are developed for the space, for space exploration or for economic exploitation of space activities. These would definitely be hard to value intangible, just to mention a few, but there's endless amounts of examples. So the guidance says that ex post evidence, that means after the transaction, can provide presumptive evidence as to the existence of those uncertainties, but this is of limited use. There should be a lot of caution in looking at these things, because the ex post evidence may be used to determine the reasonableness of the developments that could be foreseen at the time, and as an indicator of the reliability of the information that was used at the time. And the ex post evidence can always be rebuttable, is always rebuttable by the taxpayer. That's a very important point from the OECD's guidance perspective. So the use of ex post evidence will not be allowed, and this is of key importance, where transfer pricing shows that ex-ante projections were reliable and that the differences arose from unforeseeable outcomes, or that foreseeable outcomes whose probabilities were originally reasonably estimated. So this is a very important caveat on the limitations of ex post evidence. And again, there's reference to the possibly covering hard to value intangibles by APAs and specific a specific point on if the impact on the price is 20% or less, or if a commercialization period of 5 years has passed, then those are cases where probably ex post evidence will not be appropriate. And with this, we move to the last point that I bring you today, which is the TP guidance on cost contribution arrangements. So the second case where intangibles are developed in-house by the multinationals, as opposed to purchased. So the cost contribution arrangement, as shown in the scheme, is a situation where we have different group members that are together sharing the costs of developing the IP, the intangibles. So in this case, for transfer pricing purposes, this means that these different group members should make contributions. This may be contributions of capital or the performance of some of the DEMPI functions, or other minor contributions. And typically, a cost contribution arrangement does not require the creation of a separate legal entity, so it's just an agreement between the parties for the sharing of the costs relating to the development of intangibles. And what the OECD guidance says is that the sharing of the benefits from the intangibles should reflect the expectation of benefits when the contributions were made and the extent of those contributions. So, and of course, if during the life of the CCA, there are parties who leave the CCA or that enter into the CCA at a later stage, there should be buy-in or buy-out payments, which should reflect the market value at that stage, which of course leads us back to all the problems that we've discussed about hard to value intangibles. The guidance is now in chapter 7 of the chapter 8 of the OECD guidelines, and it's broader than just for intangibles. So of course the CCA could be applicable to generating other assets, but of course it's most problematic around issues with intangibles. And the guidance provides that the participants should share the cost. The participants' share of the cost should be commensurate with their expected benefits from the CCA. So there shouldn't be an entity that shares all the costs, that pays for a large share of the costs, but doesn't really expect a large share of the benefits. That would be not in line with the guidance. Of course, the challenges are for example, estimate to determine the allocation keys to be used for the CCA from the beginning. Sometimes it's also difficult to determine what are going to be the anticipated benefits, especially when we're talking about hard to value intangibles being developed. And these uncertainties could be dealt with. That's what the OECD suggests, with balancing payments taking place throughout the life of the CCA, or at the end of the life of the CCA. And so basically this takes me to the end of the presentation. I don't know if someone from the Cyprus Fiduciary Association wants to participate,
Gaspar,
or whether there's a place for questions.
Can you hear me?
Yes, I can hear it.
I don't see any questions on the chat or the Q&A. If someone has any questions, that would be the best time to ask. Otherwise, we can have our short break and then Kostas can finish off. Anyone?
Seems that everyone has been shocked by the guidance on intangibles.
Or you've said it very well, Gaspar.
One of the two. In any case, it has been a pleasure to be with you, and I hope this has been useful. And thanks everyone.
All right, so we go on our short break and then we come back 12:05.